And then how do you decide when is the right time to sell?
That's the most difficult question. And some of the names you mentioned, including Bajaj Finance and iShares, I think the regret is that we sold it very early. That will always happen. I think equity markets are full of regret. If you don't buy something, you regret if the price goes up. If you buy something, you regret when the price goes down. Same thing, if you sell, you regret because the price goes up. And when you don't sell and the price goes down, you regret not selling.
Yeah.
So regrets are a way of life. So I think that is going to happen. I think from selling side, 3-4 things which we keep in mind. One is if the valuations are running much ahead of the best and best things. Best, I would say, scenario analysis, then obviously it makes sense to sell. Second is, which is the most important, if things are not working out the way you know, I think that is where you have to realize, and it's very difficult. Many times, if you have bought something and the price is lower than what you bought, it's very difficult for any investor to sell, whether it's institutional or retail. But the moment you realize that the price fall is not because of external circumstances, but because of the fact that the company is not performing the way one expected it to perform, I think you have to cut. Yeah. Third is capital is limited. To buy something, you'll have to sell something. So if you come across something which is extraordinarily more lucrative than what you already have in the portfolio, it might make sense to churn. So these would be the 3 main reasons of sort of selling off.
Yeah, and also, are there any quantifiable factors that you look at, like, PE being one of the most debated?
See, PE in isolation might be important, but you also have to look at relative PE. So I think only PE will not be very relevant. PE has to be combined with growth. So I mentioned, 70-80 PE for a company growing at 40-50% is fine. A 70-80 PE for a company growing at 5-10% is an issue. So I think you have to combine growth rates, PE, moat, future potential, and then you have to come in. So it's not, I would say, straightforward. Otherwise, all mathematicians would be great investors. So, it's a combination of a lot of things, the noise around you, the environment, obviously interest rates are very, very important. I would say the last 3-4 months markets have been what they are because India has such a huge, I would say the RBI governor has just infused so much liquidity in the system. We have had interest rate cuts. I think it helps the economy, right?
Absolutely. It definitely, any kind of liquidity push does help the economy. But, going back to your theme of regrets, can you talk about some regrets and what's your emotional way of dealing with it now? Now that so that people who are in their 30s, 20s can learn from managing regret better.
No, so I think regrets, I would say, are multiple every day. And
Absolutely.
I gave you the 4
founder,
regrets.
You have regrets all the time.
You have not bought something and the price moves up. You have bought something and the price is down. You have sold something and the price moves up. You have not sold something and the price moves down. And every day it happens. And every day is a learning. The only thing is, we are in a very dynamic profession where what you do, you get results every minute. Every minute of every day of the year and years and years. And I think to that extent, one has to then start to accept the fact that all you need is to be more right than wrong. You can't be right all the time, And I think that is where I would say experience and maturity helps, So if you get desperate to capture every move up and every move down, you will not be able to capture anything. And I think that is where I would say maturity and experience comes into play. And communication as far as external investors has to be crystal clear because ultimately, if you're dealing with public money, you have to also manage the external expectations and I would say anxiety.
Absolutely, because 30-40% drawdowns in people's portfolios.
I think the investors have matured a lot, but compared to where they were earlier.
How has that changed? Because you have seen this behavior from your mutual fund days to now running a PM.
So one is equity investment is become mainstream. So earlier it used to not be mainstream. Investors were investing 2-3% in equity and they were just focusing a lot on that. So we used to always say that 97-98% of your investments you don't even track on a yearly basis, and this 2-3% in equity you track on a minute by minute basis. That was the thing. I think investors have matured.